we were in negotiations.
Investing in real estate, they're winning, they're making money.
Hey, what's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I am your host, Kevin Amolsch. This podcast has been so much fun and is a little bit different than others you may have heard in that we help real estate investors and content creators or real estate educators. So if you're out there marketing to real estate investors or you are an investor, this is the podcast for you. I have a very special guest with me today. We've met a couple of times, Keshav. And this is what I know about you. We have a lot in common because we both think that alternative investments is a great way to diversify a portfolio. So you've been doing this for several years now, the founder of Clive Investments. I think I said that right. And you help high net worth, high income earners, especially in the tech field, invest in alternative assets like private lending, real estate, and energy. And what I thought was very impressive is over 900 apartments and over 500 single family homes. Wow, that's pretty impressive. So let's get into it. Welcome to the show, man.
Yeah, thanks so much for having me on, Kevin.
So Keshav Kolur, I did not say your last name in that intro, but take me back, man. Take me back to the beginning when you first started getting excited about real estate. So I know you wanted to create some freedom for yourself, but why real estate?
Yeah, great question. I knew that growing up, I really liked traveling, and I saw my parents, commute to work an hour each day, sometimes even an hour and a half in traffic. And then I saw them look at the stock market every day, the ups and downs. I remember seeing, I think her name is Betty, on Bloomberg reporting. The Dow's up, Dow's down. I remember seeing the Dow at like 9,000 at some point. Now it's at like 38, something crazy thousand. And I just remember saying, this is not the life that I want to live. My parents they immigrated here. Either they're first generation or I'm first generation. I forget the difference, but they moved here and I grew up here. So they did the best that they could, but I thought to myself, there has to be a better way. So, but no one I knew of this better way. Everyone else was stuck in the same commute, same 9 to 5. So after I graduated college in 2019, I graduated college and started work as a software engineer at a car company in Detroit. I started learning about real estate investing and read Rich Dad Poor Dad like many of us do. Yeah. And I didn't glean syndications, which is what I do now. I didn't glean that from the book. Maybe I should have. But I got real estate at least from the book. So I got my realtor's license on leap day of 2020 exactly, actually. 2 weeks later, COVID shuts down the markets. But then it opens back up, towards the end of the summer. I sold a few homes, started looking at rentals to buy. And my friend from college, now my roommate actually, his dad had been investing in syndications and he came across a Reddit thread. My friend did, not his dad. And he sent it to me and he's like, hey, this guy bought 40 single family homes, then ditched them all for buying apartment buildings. You should check it out. This is September of 2020. And I thought buying apartment buildings sounds so much cooler than buying one home at a time. And that it was passive and that you got these superior risk adjusted returns. I will also say that I'm not a legal, financial, or tax advisor, any of that. Neither is Kevin, or maybe Kevin is, but we're just two dudes chopping it up on the podcast. Yeah. But these returns are 15, 20% projected per year, and they're passive, and there's tax benefits. And to me, it sounded too good to be true. If it's better than the stock market, why isn't everyone doing it already? And so I took the next year from September 2020 to September 2021 to kind of vet this concept of syndications for myself. And once I felt comfortable, I invested with the guy who made that Reddit post and invested into 108 apartments in San Antonio. Never went down the single family route. For me, at least, I consider that lucky, to each their own. But I started seeing that syndication issuing dividends, right? Cash flow. I got my K1 tax form and I was like, this is not a scam. And I figured if I'm going to do this for myself, I might as well do it for my friends and family because what fun is it being successful alone? And so I started Clive Capital in January 2022, and we help, like you said, primarily tech professionals, but other high earners invest into real estate, energy, and private lending at the moment. And the goal is primarily three things: achieve higher risk-adjusted returns, right? We don't want to take on a dumb amount of risk. Otherwise, we would all just go play the lottery. Two, build that passive income, that cash flow for ourselves so that we can open up a life of options. And then three, tax benefits. High earners pay 25, 30% net of their income to taxes. And it's one of our biggest obstacles to building wealth. And if we can legally and passively reduce that, then why not? And so, like you said, yeah, over 900 apartments and 500 single family homes so far, just in 2 years. And that should be picking up quicker pace here soon enough.
That's amazing. What an amazing journey in actually a pretty relatively short amount of time. I mean, we're in 2024 right now, and you really didn't get going until it sounds like the end of 2020, so almost 2021. Am I getting that right?
Yeah.
That's awesome, man. Great job. So you did skip over this piece, and so I want to back up a little bit. You said you got interested in real estate, and then you read Rich Dad Poor Dad. So for me, Rich Dad Poor Dad was one of the reasons I got interested in real estate. So what was it that got you interested in real estate?
I think just growing up, this is kind of cheesy, but growing up, we lived in Denver for a period of time. And my mom to this day tells me that the only way to get me to go to sleep as a 2-year-old in Denver was to drive around downtown and to get me to look at all the big skyscrapers. And growing up, I think like a lot of us, I like playing Monopoly a lot too. And so I couldn't have even fathomed syndications, but I at least was like, hey, real estate's a great way to build wealth, right? A lot of people, their primary source of their net worth is their home. So why stop at one home if you could, buy others and then rent them out to people and provide them a quality living?
So outside of Rich Dad Poor Dad, I love the monopoly thing, by the way. I don't hear a lot of people say that, but it's very true. And it's what Robert Kiyosaki talks about all the time. 4 greenhouses, 1 hotel, right? Trade up, 1031, whatever. But so how did you learn how did you learn this? Because most people go the more traditional, hey, 1 single family door, 1 fix and flip, and then let's try some commercial. You jumped right in. So walk me through that.
Yeah. So I would say once I met that guy who posted on Reddit about it, that was September of 2020. I reached out to him and just said, hey, I'm interested in learning more about how this works. I'm a software engineer and I just want to learn how it works, right? Like, this is very interesting. At the time, I think he was posting on Reddit to find more investors, more passive investors. But I figured, hey, I was 23 at the time, maybe 22. And I figured I could provide some value to him, free value, which I know that term gets thrown around a lot, but I had 23-year-old time and energy, and I was pretty good at math. So underwriting, financials, putting automations and systems together, that all kind of came naturally to me. And he hosted weekly Zoom meetups. I didn't know if that was a thing before COVID or if that's a result of COVID, but I hopped on one of those calls after I talked to him. And then I met a bunch of other people on those calls who then hosted their own meetups. And it just became this like web that just kept expanding out and out and out. I kept asking people for like, hey, I'm just starting out. How can I learn more about this? What books would you recommend? What podcasts, what videos, YouTube videos, people you'd recommend I connect to? And the business world is very forgiving and encouraging to beginners, especially in the syndication space.
Yeah.
People are very supportive of each other, and it's a very abundance mindset where they're like, hey, you might not directly invest with me, but if you're interested in learning about what I do, I'm happy to spend 30 minutes of my day to share more. And that's all I needed. I just got 30 minutes from person A, person B, C, D, and it just stacked up. And I kept networking and networking until I found someone who I wanted to find a mentor. So I found someone who was in the business already for a couple decades, saw himself staying in the business for a few more decades, and needed help in something and really liked to teach others. So my business partner now on our build to rent business, where we have those 500 single family homes under construction, his name's Andy McMullen. That's him. He's been in real estate for a couple of decades. He went through 2008. We're just starting on the build to rent trend that we're really excited about it. So he still has a couple decades ahead of him. And he really likes teaching. He's a basketball coach, among other things. So he really likes to give back to his community. Sometimes I joke that he's too good for his own good.
So he's your rich dad.
Yeah, basically.
Oh, that's cool. So I've been reading in Denver specifically that there's rent to own or rent to build to rent, see if I get this right, communities that are stalling out. And the reason for that is the cost of construction, the cost of getting through the city, all the approvals has just gone up so high that the numbers no longer work. Sounds like that's not the case in your projects or your area.
No, our build costs are still pretty manageable, but the flip side of it is the 3 developments we're working on right now, at least, are in Louisiana, in Lafayette, Louisiana, and Foley, Alabama. If you haven't heard of these markets,
I have not heard of those.
you're not alone. And so there's a reason why the cost is significantly cheaper. But the reason we know about the markets is because some of our partners, our general contractor, our landscape architect, and acquisitions guy, they live in that region. So there are boots on the ground. So yeah, I mean, it really depends, right? Like there's so many factors, like you said, there's costs, there's regulations, there's other developers' supply hitting the market, demand,
Yeah.
all these different things. So I think we're starting to see that real estate is becoming more of like a local market thing rather than just a national thing. Some
Yeah.
markets are doing pretty well now still. Others like, Phoenix and Austin, which are over speculated, are cooling down a little. So
Yeah, it's so location specific. And I think all the listeners know that. Now, I don't know anything about those markets that you're talking about. I've never heard of them, as I just said. But is there any risk for just the sheer amount of apartments coming online? I know apartments are finally catching up and pretty much across the country where there's a lot in the pipeline. Is there any risk to you with what's going on with the new apartments?
not in the markets that we are in, on the build to rent side of things, at least. And that's one of the advantages of being in these secondary, tertiary markets is that you're not going to have these big groups out of New York, Chicago, LA, and the national home builders just dumping supply left and right. So the flip side of that is it is more difficult to raise capital because, like you said, they'll be like Lafayette, who now?
Yeah, exactly.
And then that specific part of the country, insurance rates are also through the roof because that's right along the coast.
Oh, yeah, that makes sense. So we have a Lafayette, Colorado. So when I heard Lafayette, that's what my mind immediately went there.
Yeah.
So I own some land in a little place called Las Vegas. I don't know if you've heard of it, but it's in New Mexico on Story Lake. So I got this land in Las Vegas, New Mexico. I didn't even know there was a Las Vegas, New Mexico. Did you know that?
No, I just found out now.
Yeah, it's crazy. So there's Lafayette in Alabama, you said?
Louisiana.
Lafayette is Louisiana.
Yeah, Louisiana.
Okay. What's the town in Alabama?
Foley,
Alabama.
Yeah.
Cool. So what's your preference, the single family homes or the apartments? Because you're doing both.
I am a man of diversification, as I think all investors should be, right? The place where I will stray away from diversification is that I don't like the stock market at all. If I could have it my way, I would not invest in the stock market at all. I think to sign on some of these loans, which I hope to do in the future with our group, you need to show a certain amount of liquidity and net worth. I think that liquidity has to be in the stock market. If there's a way around it, I would gladly have a way around it. But otherwise,
I got it for you. Here's your way around it.
Okay.
If you get a brokerage account that allows you to pledge the account as collateral for a line of credit, then you have access to the money. But when you show your statement, it's just showing the statement of the brokerage account. It doesn't show that it's been pledged as collateral. Have you heard of this?
I haven't, no.
Okay, well, that's your solution.
What was it called again? Run that term by me.
So the term, each bank or brokerage house has a different term for it.
Okay.
I happen to know Charles Schwab. It's a PAL, PAL. It stands for Pledged Asset Line. So it's a line of credit that is collateralized by your brokerage account. But what's really cool about it is you get your statement. Let's say you have $1 million in your brokerage account that you have used as collateral. You get your statement and it just shows the $1 million in the account. It doesn't show that it's pledged for the liability, right? So now you still have access to it without liquidating stocks or without having to liquidate the account.
Interesting. Okay.
I don't know. Sorry. Went off on a little tangent there for you, but I heard you say that. I'm like, I figured this one out. I did learn this one.
It's helpful. I'm also looking at infinite banking / life insurance. Maybe that's an alternative, but I do like build to rent. To answer your original question, I do think that's where the future of housing is going, where more and more people will have to rent, especially if interest rates stay this high and housing stays this high also. And if you have to rent, why would you rent an apartment building where you have neighbors, here and here, here and here, when you could just have your own house, your own backyard, your pets can run around, your kids can run around. So, but all that say, I don't want all of my eggs in one basket, even if it is something as great as build to rent or real estate. So I like multifamily. I recently also, I know this is primarily real estate, but this might pique the interest of some folks, invested into an oil and gas opportunity. That's why I mentioned energy, where we bought land in Wyoming, and a private $1 billion company is coming to, they've already been drilling on it. And I invested in November, and I already got 25% of my principal back in the first month in May.
That's crazy.
Along with the tax benefits, where typically for every 100K invested, you can save 30 to 40K. Again, not tax advisors. That's just what I'm seeing.
Oh, that's interesting. So I did a land development deal, and it was 80 acres. And when we bought it, it came with the mineral rights. Now the water rights were already stripped off, and they were pledged as collateral for a loan, and then they defaulted on the loan. So that was basically lost in a foreclosure before I even got involved. So no water rights. But it did come with mineral rights. So we stripped off the mineral rights, did our land deal, and we held on to those. And so now every 3 years or so, we get a check for like $100, $110, $120,000 for a 3-year lease. They pay it all up front. It's really great. And then they start to explore, right? So in my case, they haven't explored yet. They just pay the lease payment every month. But when they do, then there's a royalty on top of that. I think that might be where you're going here, but we negotiated a 20% royalty. So what do you think? How do we do?
I think that's market.
Pretty standard.
I'm still new to oil and gas, I'll admit. That's actually the next series of lead magnets that I'm working on, educating people on oil and gas. But I've heard 15 to 25% standard. So
okay, so I'm right in the middle. So I did sort of good, sort of bad.
Exactly.
Yeah, that's awesome. Okay, so cool. You skipped the single family. You own your house now, though, I assume?
I live in New York City, and I'm 26.
So no way.
Not a trust fund baby, so no.
Okay, but you're definitely heavily involved in real estate investing and syndications. So let's help our listener out here. How does somebody go from software engineer, fresh out of college, getting hit with COVID and the whole pandemic, into 900 apartments, 500 houses? How do we do it?
Yeah, I think the first thing to realize is you have two routes when you approach this type of investing. You could either go the passive route or the active route, right? And passive investors, like my investors, for example, they have their day job or their business, or maybe they're retired, whatever it is, and they just want higher returns. They don't want the headaches of property management, of vetting sponsors, of dodging around, or not dodging, complying with all these legal regulations and learning about these legal regulations, learning about taxes. Good God, I have yet to file my taxes.
Gosh, just tell me about it.
And so I would say if that all sounds a lot to you, then I would say go the passive route, right? Find someone you trust and invest with them. And we can discuss more about what that looks like. But if you want to go the active route, right, then I would say, one, figure out what your niche is going to be. Do you want to just be a fund manager and allocate capital? Do you want to actually put the deals together and run the deals and be the operator? Do you want to do both? Right? And once you have that kind of set, pick an asset class. This is kind of no specific order. I would say all these questions should be mulled together. Pick an asset class, right? I picked build to rent primarily. Multifamily value add is a great asset class. Oil and gas is a great asset class. Private debt, like private lending, is great. Buying up small businesses, that's great too, like laundromats, right? Things like that. Because Gen Z is not Gen Z, Gen X. The boomer generation is retiring, and so a record level of businesses are hitting the market right now. All that to say, like, there's so many different ways out there to make returns. You just have to pick a vehicle and get really good at it. Don't get distracted with shiny object syndrome.
Yeah, I love this advice. Oh, I'm sorry. I didn't mean to cut you off. Keep going.
No, go ahead.
I just want to make sure that's very clear to the listener here, because I see investors make this mistake. If you're looking at laundromats, for example, that's a great example of a business inside of a piece of real estate. And you said it, and you're absolutely right. I agree. That is a business acquisition far more than a real estate acquisition. Without that business operating inside the building, there's no value there. So be careful buying something that you think is a passive investment when it's actually an operating business. Very, very different than a real estate investment. That's all I wanted to say.
Yeah.
Keep going.
I mean, honestly, I would even say like single family homes. That is also a business, right? Like even if you were to buy one single family home, the misconception that I find a lot of people run into when I talk to them, because I talk to investors all the time, right, to raise capital, they think that they can go buy a single family home and they'll do great and it'll be just fine. They don't realize that the toilet's going to break. They don't realize that your tenant's going to vandalize your property. They don't realize that the property management company is going to steal from you, contractors are going to steal from you. And it's not as passive of an investment as most people think it is. Just like you were saying, the laundromats, like just because you buy something doesn't mean it's going to operate itself at the end of the day. Otherwise, we would all just go out there and buy something and just sit on the couch.
Yep. Even a coin-operated car wash. So you hear about these, but you brought up laundromat, which is why I use that as an example. But normally when I take phone calls and people are looking to acquire real estate and they tell me about how amazing the ROI, the return on investment is, it's because there's an operating company in it. Some examples that I hear: hotels, other types of hospitalities, short-term rentals, that kind of thing. Assisted living is a big one. Rent by the room. These are all different than single-family rentals. I believe what you're doing, it's a long-term rental built to rent, but it's still year leases, I would assume. It's not a daily operating business, right? So if you're going doing an assisted living, that is absolutely a business that is not a real estate play.
Right.
My humble opinion.
So hopefully we're saving someone out there from making some.
Yeah.
Decisions.
I mean, I'm not saying, and I'm not. Keshav, I'm not saying that it's a bad investment. So please hear me. I'm not saying that at all. It could be a fantastic investment. And you're right. There's a lot of businesses for sale. It's just not a real estate. That's all. Let's just make sure that we understand the distinction. In fact, I'm going to go so far, and I don't know why I'm going on this rant when this is about you, but I got to say this. I would go so far as to say you should probably set up two entities, one for the real estate and one for the business. And then you should lease the building from yourself to maximize the value of the real estate.
Wow. That's a great tip.
Sorry. I just kind of go off on my tangent here because you were giving us some fantastic advice on how to get going. And I agree with you. It's all about the vision. What are your goals? What direction are you going to? So what else you got for us?
Yeah. I would say once you've picked, passive versus active, and you've picked, we'll call it fund manager versus operator, how active you want to be in the business. Pick an asset class, and they're all good, right? And someone's making money in assisted living, someone's going to make money in ATMs. There's a million ways out there to make money.
Yeah.
So just pick one and get started. I would say find a mentor also.
Ooh, good one.
Like I mentioned, right? Find someone who's a few decades ahead of you and has the experience so that you can learn from them and then provide some value to them and figure out what that value is ahead of time. Don't ask them, oh, what value should I bring? Like you should be proactive about it and never just don't stop showing up. Show up every day, be consistent. And going back to that shiny object syndrome, I think it's the Kruger's curve. There's some curve out there where it shows when you initially get into something, there's like the hill of excitement or something where it's just, oh, you're in love. This is the honeymoon phase. Real estate is so great. It's going to be rainbows and butterflies. And then you start figuring out how much you don't know. And the excitement slowly comes down. You're like, oh shit, like this person just vandalized my bathroom. This contractor stole from me. I have to figure out what a LLC is or an S Corp is and this and that. And then you hit your valley of despair where you're like, if things could possibly not get worse. And most people quit somewhere between the peak of excitement and the valley of despair.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. What is this curve called? I don't think I've seen this, but I love it.
I think it's Kruger's curve. There's so many. Let me look this up.
Let's look it up. I think this is good.
The Dunning-Kruger curve.
Sweet.
Yeah.
Keshav, this is gold. Thank you.
Yeah. And that was me too. That was me. I was like, oh, it's going to be, peaches and tulips. Like we have 100 homes under construction. We bought another 20-acre parcel. Now we have 260 homes under construction. Things are good. What could possibly go wrong? And then the climb down started, right? Insurance rates started doubling in the Gulf Coast and probably just everywhere in general, but especially in the Gulf Coast. Interest rates also started climbing up and capital markets started turning very conservative. People were very scared to put money anywhere. They didn't know what was going to happen with interest rates, with recession, etc. And that's the valley of despair. Like capital started coming in, costs started mounting. But we're still sticking through it. Those 500 homes are still under development. We're figuring out how we can preserve investor capital on all of them and maybe move forward with just 2 or 3 of the developments. But most people exit. Again, somewhere between that peak and the valley, they exit, they latch onto the new shiny object syndrome, and they start their Dunning-Kruger curve all over again. And best case scenario is you stick all the way through and you get past that valley of despair and you actually become competent and you're like, okay, I at least know what I don't know now and I'm more grounded. But a lot of people get stuck in that loop of exiting the point between the peak and the valley. And then some people never get started at all. So.
Okay. So I'm processing this as you're speaking to me because I haven't heard this before. And we've done quite a few podcasts now and no one's ever brought this up. So this is very educational, exciting for me. So I'm trying to picture like you or somebody else that's newer at the peak and then they're on their way down to that valley, that despair that you described.
Yeah.
And that's when people are jumping off the boat, right? Or getting off the bus.
Yeah.
So what do you do to make sure you stay on there so you can get to the end?
Great question. It's a question I ask myself every day. As far as how you stick on the path when you're on that downhill from the peak of hope or excitement to the valley of despair, That comes down to one, making sure that you did your research in the beginning when you got started, right? When you got into something because the fundamentals made sense and you didn't just follow the hype train. That, in the tech world, for example, that in 2020 or 2019, it was crypto and blockchain. And then now it's AI. So one, make sure you're not jumping from hype train to hype train, right? Before it's multifamily, then like industrial and self-storage had a moment. So be solid in your fundamentals. That's one. And then two, just realize that this business, whatever business it is going to take time. And that if it was so easy, everyone else would be doing it. And pride yourself in that you're going through these struggles, because if you're surviving, that means 5 other people next to you, metaphorically, 5 people next to you, if it's a race, dropped off. Like they just called it quits in the race. So this is what I tell myself to keep going every day, at least. Hopefully it helps.
No, I think it's great. What's next for you, man? You got so much going on and so many opportunities in front of you.
Yeah, I think next for me, primarily I see myself focused on the 2 businesses. One of them is the build-to-rent business at Legacy Acquisitions with my partner, my mentor, my rich dad, Andy McMullen. With the 500 homes under development, I'd love to get that number to 1,000 homes by the end of this year. And then 2,000 the next year. There's a 2 to 4 million deficit in the housing supply in this country. We just haven't been building enough because of zoning regulations, rising costs, things like that since the great financial crisis, maybe even earlier. So if I could put a dent in that deficit, that would mean a lot. With, quality housing, quality built-to-rent housing.
How do you, this is so staggering, the numbers you're talking about. So how do you fund that?
That's where great question. That's where the syndication concept comes into play. So at a high level, a syndication comes from the word syndicate, right? To bring together. And syndication is a bunch of people bringing together capital. And so these investments that we're talking about, the way we're able to buy 900 apartments, finance the construction of 500 single family homes, it's not because I'm bankrolling it. Otherwise, I wouldn't be living in an apartment. It's because we raise capital from investors, everyday investors, friends, family, coworkers, social media, all the way up to big banks, private equity firms, institutional investors, family offices, sovereign wealth funds. You can get as crazy as you want. But these different individuals and entities bring their capital together. And let's say one of our build-to-rent projects right now, 241 homes, we are building that for about $55 million. In real estate, at least, I'm not going to talk about oil and gas or energy. We'll keep it to just real estate. Similar to residential, the bank's going to require you put down 30 to 40%. And the great thing about real estate is then the bank will come in with their capital. And hence the term leverage. You get to leverage their capital as debt. And the down payment that's 30 to 40% on this $55 million deal, that's about $17 million of equity, the down payment, basically, if you want to call it that. We raise that from investors. So everyday investors, my parents have invested with me on our syndications, my other family, my friends from high school, coworkers, ex-coworkers, all that stuff. And again, they're the passive investors or the limited partners. They're basically saying, hey, I don't know real estate or I don't know oil and gas, but I have a job. I don't really want to pick up a second one. I just want better returns than the stock market. And you seem like a trustworthy person. And there's questions you should be asking, right? And that's a part of what, something I'll give away to your listeners later on. You shouldn't go around trusting anyone, but make sure you trust the people that you're allocating capital to, that you're investing with. And then those people that you're investing with, they're the general partners, the sponsors, the operators, all the same word. They actually manage the deal. And it's a team of 10, 20, 30 people who oversee the renovation of 600 apartments or 200 homes or the drilling of 10 million barrels of oil. whatever the business plan is, buying 50 laundromats.
So you've mentioned diversification multiple times today.
Yeah.
And so this is something you and I agree on, but I do want to point this out. And I just want to get your response. I'm having a brain fart at who it is, but a very well-known investor, which is going to come to me, Berkshire Hathaway. What's his name?
Warren Buffett.
Buffett.
Yeah.
Gosh, I don't know why that slipped my mind there. But anyway, so Buffett will disagree. You know what he says?
Yeah.
Don't diversify. He says, get highly focused. Find something that you really, really understand and are good at and invest in that. So
yeah.
What's your response?
So, that's unfortunate. My camera just died. It's just Mac camera now. But my response to that would be, I think when Buffett says don't diversify, he's talking about the spray and pray that most people are accustomed to in index funds and ETFs, right? Those are hundreds of companies. And some of them are zombie companies. They're not actually producing any revenue at all. And right now, I think the stock market is primarily held up by the 7 big tech stocks. And that's just risky. If 7 big stocks are holding up the majority of your market in one sector too, it's not industrials that are holding it up, other things. A lot of it is tech. But I think that's his point. Don't go the point of hundreds of companies or thousands of companies. But even Warren Buffett, his portfolio is diversified, right? He has Apple in there. He has Chevron in there. He has, pretty sure he owns Geico. I think Geico Insurance is in there. They have a realty brokerage, or Hathaway realty brokerage. He has a bunch of companies too. It's just that he analyzes each company one at a time and decides to make an investment based on that, rather than just throwing, $1 billion at each of them. So he evaluates each of them and makes sure that they're a worthy investment. And I think that's what he means, where he says that you have to become an expert in it. Don't just blindly diversify. And so that's kind of the advice that I follow also, where I don't want to just be in built to rent. I do like multifamily and I do like oil and gas. And I'm going to take the time to learn them and become an expert at them and find different companies within those niches that operate in there. But I'm not going to invest in the index funds because I don't know what company 499 out of company 500 is doing.
Yeah.
And what their financials are like.
That's very good. I don't understand the stock market at all. I do think I need some. I know exactly.
Yeah.
I do think I need some exposure there. So I choose to invest in index funds because I don't have the time, energy, or know-how to analyze individual companies. So that's interesting you say that. So I do agree with you. I just don't have the time, and I still want some exposure because I do believe in diversification. So yeah. I've got money in some crypto, some stock, and then obviously heavy in real estate. So something you said is you really do like multifamily. Now, I know multifamily, just like every market, is cyclical. It goes up, it goes down, markets breathe, right? And a lot of experts will tell you that office and multifamily, those are the two categories that a lot of people are saying are at their peak. And there's nowhere to go but down. So do you have any thoughts around what some of the experts out there are saying?
Yeah. Well, I will say one, they are probably experts for a reason, but two, I don't know that a 26-year-old can really say much against them. But my view, limited view, with a grain of salt, is that I don't know much about office, but multifamily, again, it's a very market dependent thing. One of the opportunities that we looked at a few months ago was very special because there was a tax abatement strategy involved with it, where we didn't have to push rents at all. We actually had to keep rents low. And in exchange, the government eliminated our property taxes. And typically, when you're improving the profitability of an apartment building, most people focus on increasing the revenue. In this case, we're actually focused on decreasing the expenses. So I would say that now is definitely a time for caution. But at the same time, people in 2018 thought that that was the peak of the market. and they missed out on one of the greatest bull runs that we have seen in our lifetime.
Yeah, that's true.
Granted, it was a black swan event, and I don't know that that'll happen again. Knock on wood. But there's deals out there still being done today at good prices. So you just have to find them. You have to be conservative in your underwriting, your financial projections. If that's oil and gas, for example, then if oil's trading at $80 a barrel, look at what happens to your returns if it's $70 a barrel, right? Do that sensitivity analysis. And in multifamily real estate, if the market rate rents are $2,000, what happens if you're at 1950? What happens if your vacancy goes from 95% occupied to 90% occupied? What if your exit cap rate, instead of being at 5%, expands to 6%? So investments are not guaranteed in this world, right? Maybe treasuries are. There's like some class, I'm sure that, where the returns are guaranteed. But anything else, someone tells you returns are guaranteed, they're lying, because otherwise they would have been the richest person on this earth if they could guarantee returns.
You mentioned treasuries as a guaranteed return, which that's what we're told. And then, Keshav, you know that it's treasuries that took down Silicon Valley Bank, right?
Yeah.
They
exactly.
lost their ass on treasuries. So even treasuries are not guaranteed.
Yeah. So that's a great distinction. Now I know. But people always ask me, are your returns guaranteed? And it's like, no, are your stock market returns guaranteed? Like what if anyone could guarantee you investment returns at any decent rate, richest person in the world, easily.
Yeah. I guess money market might be it, right? Because you actually can liquidate and not lose on your return, unlike a treasury. So
Yeah.
money markets, that maybe that's it. I don't know, but yeah, good point. So you start getting into a little bit of diligence there with that last answer. You're talking about sensitivity analysis and underwriting at maybe a higher cap rate. So walk me through quickly, because we're about out of time, but how do I underwrite a passive investment? What should I be looking for?
Yeah, it really depends on your asset class, obviously. Again, look, we'll talk about the three that I'm involved in: build to rent, multifamily value add, oil and gas. Each of them are going to be underwritten differently. But I would say make sure the paramount thing, regardless of the economic environment, like macroeconomic environment, the deal itself, know who you're investing with. Because if they're a good sponsor, they or someone on their team will take the time to answer your questions and properly educate you on how to evaluate an investment, because that's their job day in and day out. It's not your job as whatever you do, right? A software engineer, a doctor, a lawyer. It's not your job to be an expert at underwriting. Your job is to go out there and save lives or invent. But I would say, I went on a tangent. Your thing was, how do you evaluate?
Just like give me some pointers, or our listeners some pointers. If I'm going to look at you or some sponsor B or C over here that are doing apartment syndications, how do I know I'm staying safe?
Yeah. I would say, one, the most important thing in any deal, in any syndication, and with respects to a lot of things in life, it's about the people. So know who you're investing with, right? And again, we have a due diligence checklist, which we'll be happy to give your listeners, but figure out what their track record is, figure out if they failed on a deal before and how they managed that. Did they continue to communicate transparently with their investors, or did they start going all hush hush, radio silence once things started hitting the fan? And then once you've made sure, there's other questions you should ask, but let's assume you've made sure you're investing with the right people, then ask them, like, what should I be looking for, right? In this investment, how are you being conservative? How are you under-promising and over-delivering? Look at, one thing I always like to look at is just the assumptions and historical trends, right? If I'm investing into, again, we'll say oil and gas, and let's say it's trading around $80 a barrel right now, I'm going to look at, okay, put that in the context of history. Is that high? Is that low? Is that right around the mark? Same thing with rents and cap rates and vacancies, right? How much rent growth has this market seen? How much supply is coming on the market? Why does this apartment building renovation make sense? Can this market really afford the higher rents, or are we at the peak? and the sponsor's just kind of blowing smoke, saying that we can increase rents even though we really can't. Just question everything. Just question everything and educate yourself. And primarily, though, find the right people because you'll only go so far alone. A lot of things in life are best done in a team. As cheesy as some of this sounds, it's
No,
true.
I totally agree. I mean, when I'm underwriting a syndication, I invest in quite a few. When I'm looking at that, I look at the people first.
Yeah.
Obviously, I want to know that the deal's good, but if I have confidence in the integrity and the ability of the team, then that's a project I might consider, right? So I love what you're saying. I totally agree. You
Yeah.
said there's a checklist. So you have an underwriting checklist that you're willing to give away?
I have a due diligence checklist. Yeah. So let me get the link here. So I'm going to put it here in the chat. I'll also enunciate it for our listeners. It's on our website, clivecap, CLIVECAP.com /alternative hyphen assets. So clivecap, short for Clive Capital.com /alternative hyphen assets. We have a 2-pager there. Quick 5-minute read because thanks to TikTok, none of us have attention spans anymore. So a 5-minute read to get you interested about why you should be investing outside the stock market, real estate, startups, oil and gas, whatever it is. We have an ebook that's like, hey, you had the attention span for a 5-minute read. Now let's test it with a 30-minute read for our folks who like to nerd out a little more. And then we have a due diligence checklist it says it's 110 questions. It might be more like 50, but that's primarily vetting the person you're investing with. And it's asset class agnostic. Soon enough, we'll be coming out with one specifically for real estate, but this one's regardless of what you're investing in, how do you vet the people you're investing with? Which, like we both agree, and probably most people agree, is the most important aspect.
I love it. I mean, one of the questions I haven't heard and you said was, how are you being conservative? That's such a fantastic question to ask a sponsor. So I would definitely go to the website and I didn't write it down. It's in my chat, but we're going to make sure we get it in the show notes. But I know it's clivecap.com, and go there and get the checklist. Is there an email or any other way that you want people to get a hold of you?
Yeah, email's probably the best, or LinkedIn. So my name, Keshav Kolur, or my email, it's Keshav, first name, at clivecap, like the website, .com.
All right, Keshav. So tell me how I did here. I took some notes on some of the advice and the takeaways that I personally took away from this conversation. And I want you to tell me how I did. So the first thing you said when you're getting started, you need to make some decisions. One of them is, am I going active? Am I going passive? If you decide to go active, if you decide to go passive, contact you or me. If you decide to go active, you got to focus on a niche first and then an asset class. Do that and then go out and find a mentor and be sure to add value to them. Be proactive. And then one thing you said that I love, put it in quotes here, show up every single day. We talked a lot about that. Is it Dunning-Kruger curve?
I think it's Dunning.
Dunning-Kruger curve, which I'm going to Google when I get off of here. In fact, I'm probably going to write an article and put that in my next newsletter because I really like that. Talking about peaks and valleys, and then how do you, before you hit that valley, how do you stay in the game? Get all the way to that valley. And you talked about, what did we talk about? Solid fundamentals, and then just know that it takes time. And other people are feeling the pain too, so they're probably falling out of the race. And then we got into diligence a little bit. You're going to give us a free checklist, but run sensitivity analysis. Be sure to know your sponsor and find the right people. How'd I do?
That's it. That's the name of the game.
We got it. Cool, man. Anything else you want to share before we close this out?
No, that's it. I would definitely encourage people to check out the 3 lead magnets that I mentioned. I think that, a lot of people are mostly in the stock market, if that, and I think that's unfortunate. You can do better. It is possible to do better. You don't have to pick up a second job as a full-time investor. Again, that's what Kevin said. That's why people like him and I are here to help you through that. your parents haven't done this, your friends haven't done this, but that doesn't mean you don't have to do this. You can, show them the way. So I encourage people to think outside the box in all respects of life, but also especially financially. Explore what's out there. And then maybe if it's not the right fit for you, knock it. But don't knock it till you try it.
Love it. Love it. Thank you so much for your time today. I know we went a little bit long. Sometimes we do that because the conversations are just that good. So I really appreciate you taking your time with me. And for the listener, if you're interested in private lending, investing, or if you're interested in doing fix and flip, some kind of repositioning of real estate, need some money, give us a call. Check us out on our website. Probably the website's better. www.pinefinancialgroup.com. And with that, I hope you make this day a great one. Oh yeah, I forgot to say, give us a 5-star review and make it a great day. Thanks.
Thanks so much, Kevin. I appreciate having me on.
Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.